Welcome to Business with Louis, the show where we break down complex business concepts into actionable insights and inspiring stories. Today, we're going to explore one of the most important topics in finance and entrepreneurship: private equity versus venture capital. As an entrepreneur or business owner, understanding the difference between these two investment strategies can make all the difference in securing funding, growing your company, and achieving success. So, let's dive right in and start with the basics. Private equity and venture capital are both forms of private financing, but they serve different purposes and involve distinct approaches. Private equity typically involves investing in established companies, often with the goal of acquiring a majority stake or taking control of the business. This can include leveraged buyouts, where a company is acquired using a combination of debt and equity financing. On the other hand, venture capital focuses on investing in early-stage, high-growth companies, usually in exchange for equity. Venture capitalists provide funding to startups and entrepreneurs who have innovative ideas, products, or services, but may not have the resources or revenue to scale their business. To illustrate the difference, consider a company like Facebook. In its early days, Facebook received venture capital funding from investors like Accel Partners and Greylock Partners. This funding helped the company grow and expand its user base. Later, as Facebook became more established, it might have been a target for private equity firms looking to acquire a stake in the company. One key concept is the idea of risk and return. Both private equity and venture capital involve taking on significant risk, but they also offer the potential for high returns. Private equity firms often use financial leverage to amplify their returns, while venture capitalists rely on the growth potential of their portfolio companies. Another important principle is the concept of value creation. Private equity firms often focus on creating value through operational improvements, such as cost-cutting or restructuring, while venture capitalists look for companies with innovative products or services that can disrupt markets and create new opportunities. Let's take a look at some real-world examples and case studies to illustrate how private equity and venture capital work in practice. One notable example is the story of Airbnb, which received venture capital funding from investors like Sequoia Capital and Andreessen Horowitz. Today, Airbnb is a global company with a valuation of over $50 billion. Another example is the private equity firm KKR, which acquired the toy company Toys R Us in 2005. Unfortunately, the investment did not work out as planned, and Toys R Us eventually filed for bankruptcy. This example highlights the risks involved in private equity investing and the importance of careful due diligence. First, it's essential to have a clear understanding of your company's value proposition and growth potential. You need to be able to articulate your vision and demonstrate a deep understanding of your market and industry. Second, you should be prepared to pitch your business to investors, highlighting your unique strengths and competitive advantages. This includes having a solid business plan, financial projections, and a talented team in place. Third, don't be afraid to walk away if the terms aren't right. It's better to wait for the right investor than to take on funding that could hurt your business in the long run. Finally, consider working with a mentor or advisor who has experience navigating the private equity and venture capital landscape. They can offer valuable guidance and connections to help you succeed. In addition to these tips, it's also essential to stay up to date with current market trends and research findings related to private equity and venture capital. For instance, a recent study by McKinsey found that private equity firms are increasingly focusing on sustainable investing, with 75% of firms reporting that they have incorporated environmental, social, and governance factors into their investment decisions. Another interesting trend is the rise of corporate venture capital arms, which are allowing large companies to invest in startups and access new technologies and innovations. According to a report by CB Insights, corporate venture capital arms have invested over $100 billion in startups in the past 5 years alone. In conclusion, private equity versus venture capital is a crucial concept to understand in the world of business and finance. By knowing the difference between these two investment strategies, you can make informed decisions about funding and growth, and set yourself up for success as an entrepreneur or business owner. Remember, every great business starts with action, so take the first step today and start exploring your options. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.